Hello, my name is Mike Smith and I'm the president of T&K Futures and Options Incorporated. Created a few of these educational videos to help people with the various commodity markets. Today's video is going to be on silver futures and options. Before we get started though, let's talk about risk. Futures and options investing carries significant risk of loss and is not suitable for some investors. Past performance is not indicative of future results, and only use risk capital with these types of investments. I've been trading these markets now for over 20 years, and as a commodity trader for that period of time, I tend to hear the same questions over and over about these various markets. And I just want to cover some of the main questions that I hear. First one is, how does the futures markets work? How does margin work for a futures contract? Well, margin is a good faith deposit that you have to put up in order to go long or short a futures contract. It's a certain amount. It's set by the exchanges. They can raise it and lower it. They raise it oftentimes if the markets are extremely volatile to try to curb speculation, try to slow it down. And they often decrease it if times are slow. You know, they want people in there trading because that's how they make their money. So oftentimes, if it's a low volatility environment, the margins will be less. So it's kind of what the exchanges do. They decide that, what those margin requirements are going to be. At the time of this video, for silver, the margin is $7,150 for one contract of silver. So that's how much you have to set aside. So to give you an example, let's say you opened your account for $50,000. $7,150 is what you're going to have to set aside to go. Let's say you want to get long one December silver contract. Well, that means that you only have $42,850 in available equity to do something else with. Buy options, buy other futures, whatever it is you're going to do. So that's all you have available with just one futures contract of silver on is $42,850. Let me talk a little bit about the contract specifications for silver before we get started. Silver is a 5,000 ounce contract. Every 1 penny move is equal to $50. The symbol is SI. So let's go through a hypothetical example here. Let's say that we get long one December silver contract at $14. It's not $14 right now, but I just want to use hypothetical numbers, just made these up. You want to get long at $14. So I want to go over the risk. Theoretically, your risk is unlimited in a futures trade. You know, if you were short silver, there's no end to where numbers can go to the upside. That's why it's theoretically unlimited. No one's ever lost infinity, of course. And then to the downside, your risk is limited to zero because a commodity can't be worth less than zero. You know, I doubt silver will ever be less worthless. I think it'll always have some intrinsic value. But anyways, those are the theoretical risks involved. But let's just give a for instance here. You're in this market, and the actual next question I usually get is, how do you manage that risk? So why don't we just talk about that? You're in this market, you're long at 14, you're betting higher, and you want to risk 20 cents, which is $1,000. Okay. Well, in my opinion, the best way to do that is with a stop loss order. So in this case, because you're betting up, you would have a sell stop in there. So you would put your sell stop in there 20 cents away from 14, let's say at $13.80. Now the way a sell stop works is as the market comes down, it's 14, it's $13.90, $13.85, $13.80 coming down against you. Once it breaks your sell stop level, your $13.80, it turns into a market order. And what happens with a market order is the next available price is where you're going to get filled at, getting out of here. So when I wrote down the risk, I wrote your risk is 1,000-ish because you really can't get it exactly with a stop order, with a sell stop. But because it could be, you know, 1381 is what the next trade was. Might be 1379. Might be right at 1380. You just don't know exactly. So, but that is how you manage your risk. You can manage it to 1,000-ish in this particular instance. The next question I typically get is about options. It's, what's a call option? Well, a call option gives the purchaser the right but not the obligation to buy the underlying futures contract at a specified price for a specified period of time. In this example right here, we're buying 1 December, 1420, silver call, and we got to pay a price for that, which is 15 cents. I made these up. This is all made up. That's not what it costs today. But just to show you how the math works. So 15 cents, we know every penny is $50, so 15 times 50 is $750. So that would be the cost, the premium cost of that option. You have to tack on to there whatever your commissions and fees are going to be. And that's your total cost for that option. You're betting higher with a call. Okay? A put option. What is a put option? That's usually the next question I get. Well, a put option is the opposite of a call. It's the right but not the obligation to sell the underlying futures contract at a specified time and price. Okay, so if you thought the price of silver was going to go down, you'd buy a put. If you thought it was going to go higher, you would buy a call. I made the price of the put, here's $14, so here's your call option, which was 20 cents out of the money. In the money is right where the futures market is. So out of the money is 20 cents. Where you bought it, $14.20. And I put the put 20 cents out of the money as well. So down to the other side. I made it a little cheaper for a reason. Quite often the call side is more expensive. People seem to understand a lot better buying low and selling high as opposed to selling high and buying low. It's kind of confusing how you make money like that, but you can. It's zero sum. So for every guy thinks it's going higher, someone thinks it's going lower. I want to go in here and go through also how you manage the risk of an option. Well, when you purchase an option, when you're the purchaser of an option, I should say, your risk is finite. So you have limited risk. Unlike the futures, where you have unlimited risk, theoretically, they're very risky. Yeah, I've seen people have huge margin calls, tens of thousands of dollars, even hundreds of thousands of dollars in margin calls. It's extremely risky. You certainly have to manage your risk anytime you're in the futures. When you purchase a call or a put, your risk is limited to whatever you pay. So your premium plus commissions and fees, that's your worst case scenario. You can get out of that trade at any point in time before expiration. These markets typically expire the month before. So let's say that silver expired the second week of November, this December. So this December contract would be the month before. So, you would have to lock in profits or cut your losses sometime before these options expire. I know this is very confusing. There's a lot of other things involved. People ask, well, how do you make money? How come my option doesn't move as quickly as the futures market? Well, that's the price you pay for having limited risk. It's another made-up number. This says delta factor 30%. All right, so let's say that this guy that bought this 1420 call got in the market when silver was at 14, and the market actually moved up to his strike price. It went up 20 cents. Well, 20 cents is $1,000. His option is not going to catch a 20-cent move. He's not going to catch that $1,000. He's going to catch whatever his delta factor says he's going to catch. And in this case, this hypothetical situation, that's 30%. So even though the market moved 20 cents, he's only catching 30% of that move, which is what? Roughly 6 cents of that move, which is $300. So his option accrued in value by $300 on that 20-cent move in this hypothetical scenario. All right, let's do the other side. Conversely, he gets in there, buys his call when the market's at 14, silver, and silver goes down 20 cents. Well, now his delta factor with 30%, that means he lost $300 for the day on his option, because they're only going to move a percentage of it, of the what the underlying futures market does. And in fact, even deep in the money options, typically they're not getting 100%, 98 something is what I've seen. But these markets are confusing. You know, it's pretty cut and dried when it comes to the futures. The option gets a little different. You got to incorporate theta, which is your time decay. There's vega, which is your implied volatility of options. All those Greeks you hear about option traders talking about. If you are confused and have a question, you're probably already on the website right now. That's how you're seeing this video, but just in case you're not, tkfutures.com, that's the website. My name again is Mike Smith. You can call me. I also wrote a book that's available on Amazon. It's called The No Nonsense Guide to Buying and Selling Options. It's all about options. It doesn't cover futures at all, but it does cover options. That might be another educational resource for you. I think I covered just about everything I wanted to. Okay. Well, I hope this helps, and have a good day. Bye-bye.